This is our Forex blog for May 10th, 2012, and like we do most days, we want to buy the strongest ones versus the weak and sell the weakest versus the strong. Everyone knows that you should trade with the trend. Our main concept is trade with the trend until the market moves statistically too far, wait for the momentum to die down, and then do a counter trend move. Because once the market has moved statistically too much and the momentum, if it's not radically strong or radically weak, the market usually does reverse, and so it's safer at the extreme highs or extreme lows to do counter trend. But in the middle of the range and the beginning of trends, there's no doubt that trading with a trend is the highest probability way of trading. So what time frame trend do you trade with? Our histograms are statistically comparing every currency to every other one on multiple time frames. We have a bunch of tools we average together into one reading for the real time. Underneath that we have the 15-minute trend, hourly trend, daily, weekly, monthly. So you can see the dollar real-time trend for the most part, the majority of the day is down. The 15 and hourly trend for the most part is down. The daily trend's down and pretty much stays down all day. But the weekly, monthly trend, because this is just possibly the beginning of a new downtrend or just a pullback and a very strong weekly and monthly uptrend, you never know. Is this trend going to continue down, or is it going to come down 2 to 5 waves, find a major support area, then resume its very strong longer-term weekly, monthly uptrend? You don't know that, but as an intraday trader, it doesn't matter. If you see incredible weakness, 15 hourly trends down, that's enough. And in fact, I will even take trades if the real-time trend's down and the 15-minute trend's down. If the hourly trend is still up, I know it's just a matter of time for that to change. Trends change first in real time, then in this particular example, the 15-minute trend changes, then the hourly, then the daily, then the weekly, then the monthly. Monthly can take 2 weeks to change. If it's a very strong uptrend, it might take 2 weeks of slow grinding down moves to change the monthly trend. So be aware of that. But today, the dollar and the yen are both weak. You want to trade those against the strongest ones. The Australian, very strong, real-time, 15-minute, hourly, coming up to even before midnight, and the daily trend, very strong. Same thing with the New Zealand. So those are the most no-brainer trades that you'd take if you are concerned about finding very nice big-sized winners. So let's take a look at those. Australian dollar, you can see up. You bought this little pullback right here. You would have probably had a small 5 or 6 pip loss. You buy this pullback, small win, and win. And I'm working on automated systems right now. There's no, don't email me, ask when, in programming, it's going to be done when it's done. I have no time horizon on that. But let me just add some of the signals to the chart so you can kind of see. Obviously, the deeper the pullback, the better. If you get one of these signals and then you wait for the trailing stop to get triggered to get in, you can increase your winning percentage. So you have, some buy signals right here, and then when the trailing stop has you in right here at 87, and it has you out here at 14 for a nice, almost 30 pip win. If a pullback right here would have been a loss, another entry right here, it would have been a loss, another entry right here, very small win, pullback right here, small win. And if you see, you can always increase your odds by looking at our real-time only tools. The Build Your Own Trend is a very fast tool that's made up of multiple different tools that measure the direction and the intensity of direction. So when you see a pullback like this with a lot of weakness, it's not guaranteed to go up. And if you see a pullback that has less weakness, like this one right here, notice it pulled back and there's not a whole lot of weakness right here. Anytime you get a pullback followed by some sideways range, there's clear buying here. There's a double bottom as well. So when it breaks out over these bars highs right here at 91, it's a pretty high probability trade. You can always trail your stop underneath the previous bar or 2-bar low. So when it goes up, put your stop underneath here, goes up, maybe you're out somewhere at 04, you're in this at 92, it's a 12 pip win. Nice little 4-bar pullback. Notice the pullback has no weakness. Anytime you see a move up with incredible momentum, and then the counter trend move has half or less. In this case, it's 1/4 the momentum visually. That's a no-brainer trade. So in this kind of trade, you're looking to buy it when it goes above these bars high right here at 04. And even if you got out of it with this reversal pattern right here, anytime you have 3 to 5 bars up and you have a little wick at the high of the bar, it's a reversal pattern. You might get out when it goes 1 pip underneath this bar's low here at 21. So you'd be in this trade at 04, out at 21 for a 17 pip profit minus your spread. So let's take a look at the Australian yen. This is another one that you're looking to buy. These are some Fibonacci profit target levels I do each night, and most of the time these are the maximum high that you're going to get. So you can see it went up, waiting for a pullback. You know, it went up about 10-15 pips. And for scalpers, you're going to really love using our range bars and range bar signals, because you know you can just simply trail the stop with whatever the number of pips per bar. This is a 5-minute chart because I don't typically run the range bars on this one for the classes. The New Zealand dollar, this is a 5-minute chart as well. You know, you can see nice 40 pip move up, pullback, and moved up 10 pips. I tend to move my stops to break even once the market's gone 6 to 12 pips my way. For example, when you got this pullback here and you got a double bottom right at the hourly moving average, this is a support area where if the trend's going to continue, usually people come in and buy right near the hourly. This is an hourly 20-period simple moving average. The fact that it had a double bottom increases the chance. The fact that it had pretty decent intensity on the way down would make me a little nervous. I might wait for the high of this to be broken out before getting into it. But you can see it went from around 65 up to 75. The previous day's high is right there. If you're watching this trade, notice there's some momentum. All of a sudden it falls off a cliff right here. You might decide to take 5 or 6 pips. You get a little pullback right here without as much momentum as before. Notice when any time the pullback has less than the 80 level, which we consider significant, it's not that much weakness. More momentum on the way up than down. And that doesn't always apply. Our upper containment bands usually contain price. That's why we call them containment bands. When you have a move up followed by a pullback, but it's right near the upper containment bands, you know, it's not likely to, there's not that much room for it to run. So I prefer to buy in the middle of the range, because then if it does take off, occasionally it does go over the upper containment bands. If you get in at the middle, you can, you know, find 30 to 50 and sometimes 100 pip moves. If you buy it near the upper containment band, your chances of a 50 pip move are very, very tiny. Your chances of even a 20 or 30 pip move are very tiny, and your winning percentage goes way down. So anytime you can get into a trade near the middle of the range, you're going to be better off. So let's also show the New Zealand yen, because, and especially the yen was extremely weak in the second part of the day. You can see weakness, some real strength right here, and then notice the same pattern here. Weakness, virtually half as much weakness, and then weakness comes back. Almost no strength. This is a trend that's likely to continue. So the New Zealand yen during the U.S. session was a higher probability trade. You got this little pullback right here. Notice extreme strength. The pullback has less than half the weakness visually. And look at this nice 40 pip move here. And notice where it stopped too, right near our upper containment band. So don't be greedy. Use the upper containment bands to get out of trades. You know, especially if it gets up there and the statistical momentum falls off a cliff and it drops below 80. You might want to, at the very minimum, exit half your trade. Now in the U.S. session, when the yen was one of the weakest ones, guess what? The pound was extremely strong. The weekly monthly trend was already up. And so when the short term, this is an example of a short-term counter trend move. The real-time trend was down, the hour or the 15-minute trend was down, the hourly shifted down at 2:30. The daily was also down. But when you see momentum followed by the pullback having half, because the weekly and monthly trend's up in this pattern right here of extreme strength and the pullback has very little weakness, it predicts most times the future direction, especially when it's in the direction of the daily, weekly, monthly. So 7 o'clock right here, it was clear that the weaker of the two between the dollar and the yen was the yen. You want to be looking at 7 for and anticipating a pound yen buy. So let's bring up the pound yen, and I'm going to bring up the actual range bar chart on this. Here's 7 o'clock, and this one is actually underneath the hourly moving average at the time. A lot of times when they come up to the hourly, they find resistance. In this case, at 7 o'clock, it broke through. So that's a very big sign of the trend continuing. Not only do we look for pullbacks in currencies, we also look for sideways rectangles, which you have right here, and you also very clearly have an even longer sideways rectangle right here. When it breaks out through there, you get in, and notice on our trailing stops, you're in here at 93. The stop is initially down here at 77. Within one bar, it gets yanked up to 88. So within one range bar, you have literally 7 or 8, 9, 10 pips of risk, and then look where it gets you out, up here at 21. The maximum high was 31. So it caught every pip of this move minus 10 pips. The reason for that is once it gets to our upper containment bands, our intelligent trailing stops yank the stop up, so you don't, because it's very likely to reverse enough to stop you out. Maybe the stop would have been here if I didn't have that code in there. And so you catch another 5 or 6, 7 pips.